All right. Hello, everyone, and thank you for continuing to join us throughout the day here today at the Lytham Partners Spring 2024 Investor Conference. Once again, my name is Robert Blum, Managing Partner of Lytham Partners. Extremely pleased to be joined during this presentation by Criterium Energy, ticker symbol of CEQ on the TSXV. And joining us today from the company is their Chief Executive Officer, Robin Auld, and the company's Chief Operating Officer, Matt Klukas. Before I do turn it over to management, I want to remind everyone that the company is available for one-on-one meetings throughout the conference. I know we're getting a little bit late here, but if you've not already signed up for a one-on-one and would like to do so, whether it be today or even after the event, I'd be happy to coordinate. You can send me an email. That's Blum, B-L-U-M, @lythampartners.com. Or you can go to the landing page for the conference website. That's lythampartners.com/spring 2024. From there, you can click on the investor and attendee registration and make your one-on-one selection. So with that, gentlemen, the floor is yours.
Thank you, Robert, and Lytham Partners for inviting Criterium Energy to this spring's conference. And thank you, fellow participants, for taking interest in Criterium Energy. I am Robin Auld, Criterium's Chief Executive Officer, and I'm honored to be speaking with you about our business and why I believe Criterium is a unique investment opportunity. As a publicly listed company on the TSX Venture, I have to include standard disclaimers and key terms that I've put on the board here. If you wish to review these, then please contact me through our website, where we will be able to provide you with this presentation. As you will see, Criterium is traded on Toronto Stock Exchange, and we are focused on a Southeast Asia oil and gas development, where we see favorable market conditions and an ever-expanding and rapidly rising energy demand. Supportive governments with well-established industry regulations and mature contract laws create a positive environment in which to deploy capital. We also see limited competition. As the oil majors refocus on larger assets, they leave in their wake smaller fields with many remaining barrels and substantial underutilized legacy transportation and production infrastructure too, all of which reduces the required capital for us to realize meaningful value for our shareholders. Our team is focused on low-risk, high-return strategy of short-cycle, self-funded opportunities, such as workovers, infill wells, and enhanced oil recovery techniques common in North America. Further, we see next year's 2025 production target as 2,000 barrels a day as we bring high-margin gas online. This alone will more than double our acquisition or current production levels. So while many producers are in a flat production environment, we can increase production at pace. At the beginning of 2024, we closed on $5 million capital raise and acquisition of Mont d'Or Petroleum. Mont d'Or provides us with the foundation for growth in the heart of Indonesia's energy sector. Mont d'Or also provides us with nearly 5 million barrels of 2P reserves valued at around $57 million. The picture you see here is our central processing facility in the Tungkal PSC. You can read more about us from Octus Advisors in the UK and Research Capital in Canada and the US. Now, why Southeast Asia? As more Southeast Asian populations aspire to have the lifestyle we enjoy in North America, Southeast Asia energy continues to grow at an increasing rate for the foreseeable future. Supportive governments provide contract certainty and commercial incentives to unlock domestic oil and gas production. All of this leads to premium oil and gas pricing compared to North America. For example, our Mont d'Or barrels receive a premium to Brent crude. When online, our gas should expect to receive, over time, $6 to $8 per MMBTU. Let's put this growth in context. By 2030, just 6 years from now, Southeast Asia's countries' middle class will eclipse the entire US population. Looking at it another way, 775 new cars will hit the road each day through to 2050. This represents a 200% increase in cars, replacing existing motorcycles. Or let's consider air conditioning demand. Between now and 2040, a new air conditioner is installed every 2 seconds in Southeast Asia. And Southeast Asia's total energy demand growth between today and 2050 adds the equivalent energy consumption of another Japan. No matter what, producing oil and gas in these markets is a competitive advantage to transported hydrocarbons. Within Southeast Asia, we prioritize Indonesia, Thailand, Malaysia, and Vietnam, with a near-term focus on our Indonesia portfolio of production in the Tungkal and West Salawati production sharing contracts, or PSCs. For context, Indonesia is the fourth largest population with 280 million people and is longer east to west than the continental US. You may also be interested to know that Shell's first operations in 1890 were in Indonesia, laying the foundation for a long-standing mature energy sector in the country and the region. Of late, we have seen significant investments into Indonesia from both US and China and others. In 2022 alone, the US invested over $12 billion into Indonesia. On a personal note, I have been in and out of Jakarta, the capital of Indonesia, over the last 10 years, and during this time, I've witnessed Jakarta transform itself into a modern global city with world-class sports facilities and entertainment venues. This skyline looks very much like any American city. Our team has firsthand experience operating in Indonesia, another reason why we're there, and delivering results. We have also established a productive rapport with the government's oil and gas regulators. We focus on onshore environments in the heart of Indonesia's oil and gas industry. Historic underinvestment has set the stage for us to monetize overlooked fields and excess infrastructure capacity, allowing us to bring product to market faster and cheaper. All of this is underpinned by a long-term production sharing contract through to 2042 and is, of course, to our shareholders' benefit. You should see now that we have assembled a portfolio that hits on 3 primary elements of our strategy to expand our production footprint. We create value by focusing on assets that provide the following characteristics: optimizing existing production, new or accelerating development, early monetization of step-out exploration opportunities. We have 3 production sharing contracts: the Tungkal, the West Salawati, and Bulu PSCs. We hold 100% working interest in the Tungkal and West Salawati PSCs. We hold a non-operated position in the Bulu PSC. In less than 18 months since the acquisition of Mont d'Or and are receiving the Toronto Stock Exchange listing, we have brought together a seasoned leadership team with specific regional experience and acquired core assets in Mont d'Or Petroleum for long-term stable growth through the short-cycle, low-risk approach of workovers, infills, and interventions in a target-rich environment. We are actively completing workovers, interventions, and infill wells as we speak, which when complete will add production to deliver free cash flow per share, growth and deleverage debt to cash flow. Beyond this, we will bring to market discovered and tested gas and step-out exploration near infrastructure to ensure commercial success. With that said, I would like to take a deeper look at Mont d'Or and specifically the Tungkal PSC. In Tungkal, we have the Mengope field on the left of this slide, and on the right, we have the PLT field. Discovered oil is illustrated in green, and discovered gas is in red. The yellow represents the low-cost step-out development or exploration that I mentioned and is available to us inside cash flow with production upside. The nearby pipelines and other infrastructure ensures a high chance of commercial success. In fact, you can see we are already tied into existing gas infrastructure connected to major demand centers in Java in Indonesia, Duri, and most importantly, Singapore. With this in mind, we anticipate materially increasing production through 2025 to 2026 and beyond, delivering product to these markets. We see several avenues to increase production, be it, for example, through workovers, targeting previously bypassed pay zones, infill and step-out drilling, or secondary recovery techniques such as water flood. In parallel with the production opportunities, we intend to build our reserves base and believe the workovers, infills, and step-out drilling combined with enhanced oil recovery will keep us busy for some time, and infill program alone has the potential to more than double our current recovery factor. And with our long PSC contract, we will have the time to fully capitalize on this and deplete the reservoir. The Tunkal and West Salawati PSCs provide much room to grow, with much of the required infrastructure already in place. For example, already constructed well pads and processing facilities, and when we are done, minimal abandonment liabilities are capped at just $3 million. West Salawati is also well positioned near transportation networks and provides us with production optimization opportunities through workovers and infill wells. Our West Salawati oil is high quality light crude oil that commands a Brent plus price point. Notable prospects in West Salawati alone could deliver over 30 million barrels of additional reserves. We recently released our 2024 budget and guidance. I would like to touch on a few highlights. We anticipate an average production rate this year of 1,000 to 1,100 barrels with a 2024 exit rate of 1,200 to 1,300 barrels. A $5 million CapEx budget will include 2 infill wells in the Tunkal PSC this year as well. For reference, a Tunkal well should cost between $1.6 to $2 million. We are in the process of divesting the Bulu PSC, which when complete later this year, will yield us approximately $7,750,000. Finally, we are committed to achieving a balance between financial and social profit, aligned with the UN Sustainable Development Goals, and recognize that we support our communities through responsible energy production. Since acquiring Mont d'Or, we have converted our genset to run on produced Tunkal gas, displacing diesel and reducing our emissions and reducing OpEx. To recap, Criterium Energy will self-fund production growth in the near to mid-term. Criterium will actively grow reserves on the balance sheet. We will commercialize high-value gas assets to take advantage of Southeast Asia attractive regional prices. We will delever to a 1x debt to cash flow multiple by 2025 year end. And we expect that forecasted strong regional growth will continue to provide a compelling investment opportunity. Thank you for your time, and I appreciate your response.
Fantastic, Robin. Thank you so much for that overview. Did have just a couple of questions. You've hit on a few of them, but maybe you can help expand here just a little bit. Yeah, maybe start off. What was sort of the rationale to choose Southeast Asia as your target operating region? You talked about some of the growth areas there, but maybe just expand a little bit more.
Sure, we can do that. It all underpins from demand, and the demand is there obviously by the populations, and in a lot of ways, these populations are a little bit further back in time than when we are in terms of what they enjoy, the benefits they have from energy, etc. And so that exponential growth is what we're really tapping into, and probably the fundamental reason why we see the opportunities in Southeast Asia potentially over, let's say, in North America at this time.
Right.
We have local expertise as well. Our team is all operated in the region, and we see those as being safe jurisdictions to operate in. We've got good relationships with the various governments that we need to have on our side, and and we see these undercapitalized resources that are sitting there that we can monetize to our shareholders' value.
All right. Um, Maybe elaborate a little bit further here on the gas monetization opportunity that you see there at Mount Dore.
Yeah, I think you could see from the slide all those yellow dots on the map, and every one of those is a potential target and potentially gas. So you can see that and then there's these discovered gas there as well is is prolific. And so we see that as relatively easy to bring to market also. A lot of times it's the infrastructure or the lack thereof that makes some of these projects uneconomic. And so with us having all of that legacy infrastructure in place, connected, like I said before, to Singapore, et cetera, we have good egress and therefore a high chance of commercial success.
Got it. At the end there, you talked about sort of self-funding near medium term, I think you said, or intermediate term. As you sort of continue to debt, continues to get reduced here. How do you think about capital allocation going forward?
Like I said before, for the foreseeable future, next few years here, we believe we can self-fund, and I think that's to the benefit of shareholders. It's non-dilutive. We will step out to other PSCs, and that probably would become the point at which we would look for additional capital. We would also consider, in terms of pet capital allocation, we would also consider maybe farm-in opportunities or farm-out opportunities with partners that are in the region, and that's another way to enhance shareholder value in a creative way for them.
Yeah, and if I could just jump in and add one thing there, Robin, I think when it comes to capital allocation, we're focused on short cycle opportunities right now. And Robin touched on, our workovers and infill wells. We see payback from those opportunities. In our workovers, we're getting payback in a matter of months. In our infill wells, those will be under a year. In some cases, we may be pushing over a year. So we're focused on putting that capital back into the ground and getting it back really quickly, and then recycling that and putting it into really high margin opportunities like the gas that we talked on. And that's a really low risk opportunity for us, where we can take a discovered resource and tie it into a really high demand market. And gas is a very important part of our portfolio because it will provide very stable cash flow. Whereas in North America, we produce, North America, usually we're producing into spot markets. So we see volatility in the gas price. In Southeast Asia, in Indonesia particularly, we'll be selling into fixed gas contracts. So we will receive between $6 and $8 per MMBTU. And when you put that into a relatively stable production profile, that's very predictable cash flow for a foreseeable future. So we see gas as an important part of our portfolio, and that will help kind of determine our capital allocation decisions there as we start to delever.
All right, no, that's very helpful. When maybe talk about the process and the technologies that are used to develop sort of the oil and gas in Southeast Asia. Any differences to sort of traditional practices in North America?
What we've seen, and it's not necessarily unique to Southeast Asia, North America. Maybe I'll focus on the assets that we've acquired with Mount Dore, specifically the Tunkel PSC. What we see is, I like to say, if we were to put these fields in Western Canada, they would be at about a 40% recovery factor. Where they are right now is about a 6% recovery factor. And the reason being is they're still on what we call primary development or primary recovery. And so we see a huge opportunity in bringing technologies or even best practices that are very common here in North America and applying them to the fields we have in Southeast Asia. Right. Things like horizontal or directional drilling, things like stimulating the reservoir. We talk a lot about hydraulic fracturing in North America. We haven't even touched on that or looked at that in Southeast Asia yet. So these types of things, and even water flood, again, something that's been going on for decades in North America, is also done in Southeast Asia. So the services are there, the technology's there, but on the fields that we've acquired, it hasn't been implemented yet. So that's why we focused on and quite are pleased with the acquisition of Mount Dore and getting the opportunity to introduce these best practices and technologies to the benefit of our shareholders. I'm not
All
sure,
right.
Rob, if you've got anything to add there on, we usually call it technology arbitrage, but really it's best practice arbitrage, I think.
Yeah.
Yeah, exactly, Matt. I agree.
All right. Maybe final question here. What do you sort of see as the biggest opportunity here for the company over the next 12 to 24 months or so?
I mean, from my perspective, it's keep our head down and work hard on the Mount Dore asset. I think we've shown that there's so many opportunities in there that for us to monetize those and put those into the market again, that's the work we've got in front of us for the next 12 to 18 months.
Yeah, spot on, Robin. Taking the portfolio we have, growing production organically, investing in those short cycle opportunities, and bringing on some of our higher margin opportunities, such as the Tunkal gas, discovered gas resource.
Fantastic. All right. Well, thank you guys so much for the presentation and for sort of going through some of these questions here. Want to remind everyone that if you'd like to schedule a one-on-one meeting with Robin and Matt here, shoot me an email, Blum, BLUM, at lythampartners.com, or again, visit the landing page for the conference website, lythampartners.com/spring 2024. From there, you can click on the investor and attendee registration, make your one-on-one selection there. So again, Robin, Matt, thank you so much for the presentation today. Hope you enjoyed the conference here.
Yeah, thank you, Robert. Really appreciate the opportunity.
Thanks, Robert.